Bookkeeping basics for small business owners. That's what I'm going to be teaching you, hopefully in the next 15 to 20 minutes. I have no idea how long this is going to take, but I'm going to try to break it down as simple as possible. I'm going to teach you everything I know about bookkeeping for small business owners in less than 20 minutes. My name is Zach Pasquarello, and I teach you how to start your own bookkeeping business in less than 30 days with no experience. If you're a business owner, this video is going to be perfect for you to help you understand the fundamentals of bookkeeping. If you're a bookkeeper, this video is also perfect for you so that you can learn bookkeeping, so that you can start your own business or service your clients better. If you enjoyed this video, subscribe to my channel because I'm posting videos like this every day to help you start your own bookkeeping business and to learn bookkeeping and to learn QuickBooks. And if you need more help, there's a link in the description. Schedule a one-on-one consultation with me. I would love to work with you. Okay, now let's jump right into it. I'm going to talk about the fundamentals and the basics of bookkeeping for small business owners. Okay, first of all, I'm going to give an overview. What are we going to be talking about in this video? First of all, we're going to talk about your chart of accounts, and then we're going to talk about recording transactions, and then reconciling your accounts, and then we're going to talk about financial statements. Okay, so first of all, what is bookkeeping? That's a pretty standard question. We're not going to spend too much time on an overview, but basically we are recording business financial transactions. So anytime you spend money, anytime you receive money, or sometimes there are transactions that don't actually involve cash, they are still business financial transactions. So we are recording transactions. Now, what's the difference between a bookkeeper and an accountant? Well, a bookkeeper simply records the transactions. However, an accountant interprets and analyzes the data that is recorded by the bookkeeper. So accountant is a little higher level analysis and interpretation than what the bookkeeper is doing. However, both are extremely important for a business owner, and most small businesses have a bookkeeper and accountant do both things. They record the transactions and they interpret and analyze the data. Okay, so for bookkeeping and accounting, there are 5 major accounts whenever we're looking at the chart of accounts and recording transactions and also financial statements. These 5 major accounts: assets, liabilities, revenue, expenses, and equity. I'm going to briefly explain all 5 of these. So assets and liabilities are on your balance sheet. So that's a financial statement, your balance sheet. And then revenue and expenses are on your profit and loss statement. That's another financial statement. So these accounts are completely different from each other, but they all work together and impact each other. So real quick, before we get into these accounts, I just need to tell you that on the balance sheet, we have assets, liabilities, and equity. So in order for you to understand all of this, you need to know how these 3 accounts affect each other. So assets equals liabilities plus equity. So you need to remember that equation for everything related to bookkeeping and accounting because it impacts everything. So your assets are things like your checking account or your inventory or your fixed assets like vehicles and buildings, and your accounts receivable. So if you provide services for somebody, that means somebody owes you money, and now all of a sudden you have an accounts receivable. Okay, your liabilities are money that you owe other people. So if you have a credit card, your outstanding balance on your credit card is a liability. If you take out a mortgage on a house, that is a liability. If you take out a loan to buy a truck, that is a liability. And also, if you receive a security deposit from somebody else that you're going to pay back to them in the future, that is also a liability. So if somebody gives you $500 and you need to give that $500 back to them at the end of the term or the lease, that would also be considered a liability. Now we have revenue and expenses. These are probably the easiest ideas or accounts to conceptualize. Revenue is your income or your sales. So if somebody gives you $1,000, then that would be revenue. Or if somebody owes you $1,000, remember I talked about accounts receivable under the assets. If somebody owes you $1,000 for services that you provided, that would also be considered revenue. We have expenses here. Another really simple concept: if you spend $100 on job supplies, that would be an expense. Or also accounts payable. So that would be a liability. Accounts payable are a liability. They're the opposite of accounts receivable. So if you owe somebody $1,000, that would also be considered an expense. Okay, finally we have equity. This is probably the most complicated of all the accounts. Equity would be, for small business owners, it's actually pretty straightforward. So equity is your net income. So at the end of the month, if you have $5,000 of net income, that would be your revenue minus your expenses. That net income shows up on your equity. So like I said before, assets, liabilities, and equity are on the balance sheet. Revenue and expenses are on the profit and loss statement. But we see revenue and expenses show up on the balance sheet through equity in the form of net income. And then also, if you are a business owner and you pay yourself, that would be considered owner's pay. That is an equity transaction. And then finally, if you contribute your personal money into your business, that would be considered owner's investment, which is also equity. Okay, now to further talk about these accounts, we have assets, liabilities, revenue, expenses, and equity on this chart here. These are the accounts. Now I'm going to talk about debits and credits. This is super important if you are a bookkeeper, not so important if you are a business owner. So you can probably just skip ahead to the next chapter of this video if you are a business owner, not necessarily a bookkeeper. If you are a bookkeeper, it's incredibly important that you understand these debits and credits and how to increase the balance of these accounts. I'm going to try to break it down as simply as possible, so bear with me. If this is confusing, watch it through again once and then rewind and try to watch it a second time. If you're taking notes, that's great. Pause the video, jot down these notes, and then continue watching. Okay, so in explaining debits and credits, I'm also going to further explain details and examples of these 5 accounts. Okay, so in order to increase your assets, we have to do a debit. Now this makes sense because I'm going to give you an example. So in order to increase your assets, it's a debit. Now just remember, bookkeeping, recording transactions is typically double entry accounting. So in order to increase the assets as a debit, we have to credit something else. And then you also have to remember that assets equals liability plus equity. So bear with me here. We're going to talk about debits and credits, and we're also going to relate these debits and credits on this journal entry to the balance sheet. So let's say, for example, that you just got paid $1,000 for services that you rendered to one of your customers. So we are going to increase the balance of your assets through a debit, but now we need to credit something. So if we're receiving $1,000, we're putting that into our checking account. That's a debit for the asset of the checking account. And now remember I said we provided services. So we're debiting $1,000, the asset, and then we're crediting the revenue for $1,000. So if we look at the journal entry, it's going to be a $1,000 debit, a $1,000 credit for assets and revenue. That's how we do double entry accounting, and that's how we keep the balance sheet equal. So if those are the only transaction we had on the balance sheet, we would see $1,000 in assets, $0 in liabilities, and $1,000 in equity in the form of revenue. Now, the exact same concept applies for a credit to the asset account. So let's say, for example, we spend $1,000 on job supplies. So we're crediting the asset checking account, and then we are debiting the expense account. So we're decreasing the asset account, we're increasing the expense account, which therefore decreases the equity account in the form of net income. So if this was the only transaction that we had, we would show a credit to the asset account because we're spending $1,000, we're losing $1,000 of cash, and then we would show a debit to the expense account. We would be increasing that expense account because we're spending $1,000 on job supplies. So job supplies is getting debited, checking account is getting credited, and then when we look at the balance sheet, we're going to see negative $1,000 on the assets for the checking account and negative $1,000 on the equity account for net income in the form of a debit, because assets equals liabilities plus equity. So assets have to equal liabilities plus equity. In this simple example, we don't have any liabilities, so we just have a negative $1,000 and negative $1,000 in net income. Just to keep it simple in that example. Okay, so now we're going to talk about liabilities. So let's say, for example, you acquire a truck. So this truck is going to be an asset. So we're going to debit your asset, the truck, for $50,000, but we also took out a loan to acquire that truck. So we're going to credit your truck loan for $50,000. So now if you look at the balance sheet, we're going to see a $50,000 asset in the form of a truck, which is a debit, and then a $50,000 loan, which is a liability in the form of a credit. So we have assets equals liability plus equity. 50,000 equals 50,000. Now these are all simple examples. These are all just one line per debit, one line per credit in the journal entry. But keep in mind, some of these journal entries can have multiple lines, increasing the complexity. But just so you get a basic understanding of debits and credits, I'm going to give you these simple examples. Okay, now to whenever we're paying off a loan. So let's say we're spending $1,000 to pay off one of our truck loans. So now we're losing $1,000 to the asset, the checking account, credit, and then we're decreasing the liability with a debit. To decrease the balance of a debit, to decrease the balance of a liability, we debit the account $1,000. So that makes sense. We have a debit and a credit. You always have to have a debit and a credit for every journal entry. Okay, now revenue doesn't really make sense to debit our revenue account unless maybe let's say we had a return. Maybe a customer wanted a refund. So we're going to debit the revenue account. So we're going to refund the customer, and then we're going to credit the asset account. We're going to lose that money. So we're going to spend that money to debit the revenue account. So we have a credit and a debit. Not as common of an example, but still that's how you would do it. And then the same concept with the expenses. So if we went to Walmart and we bought job supplies and we returned them for $100, so instead of spending $100, Walmart actually paid us back $100. So that would be a credit to the expense account and then a debit to the asset account because we're receiving back that $100. Now, finally, let's talk about equity. So let's say, for example, that we invest $10,000 into our business. So we're going to have a debit to our asset account for $10,000, and then we're going to have a credit to our equity account. So we're increasing the balance of equity with a credit, increased balance, credit, equity, increased balance of assets with a debit. $10,000 owner's investment. Same concept, owner's pay, but the opposite. Debit to decrease the balance of equity and credit to decrease the balance of assets. We're taking out $10,000 of our checking account to owner's pay, which is the equity account. Hopefully that makes sense. Maybe it made no sense at all to you, but that was my best way to briefly explain debits and credits. This is seriously the fundamentals of accounting and bookkeeping. If you can understand debits and credits, you can do any journal entry and you can solve most problems in bookkeeping and accounting. Okay, now we're going to talk about your chart of accounts. I have a ton of people asking me, hey, can you help me set up the chart of accounts for my company? So every time I talk about your chart of accounts, this is how we're going to be recording transactions. Recording transactions is the same thing as categorizing transactions. So we use the chart of accounts to record transactions or to categorize transactions. Now, these chart of accounts are simply subcategories beneath those 5 major accounts that I just talked about. So for example, a chart of account would be, I talked about job supplies. That would be a chart of account underneath expenses. And I talked about your checking account. That would be a chart of account underneath the assets. I talked about a truck. That would be a chart of account underneath assets. And I talked about the truck loan. That would be a chart of account under liabilities. And then I talked about owner's pay and owner's investment. Those are both chart of accounts under equity. So it doesn't really matter what your chart of accounts are as long as they are consistent and they make sense for your business. For example, some people have a category called job supplies under their expenses. Some people have a category called small tools. Some people have a category called supplies and materials. Those are all pretty much the same thing. It doesn't really matter the specific name that you give them as long as you are consistent with all of your job supplies and as long as it makes sense for your business. And the reason I say that is because if you look at the actual Schedule C, if you're a single member LLC filing your taxes with the Schedule C, there are very few actual chart of accounts on the Schedule C for your profit and loss. The majority of your expenses are probably going to be captured in this section on the Schedule C that's other expenses. So they only give you like 10 specific expense categories like insurance, office supplies, wages, utilities, major categories like that. They give you like 10 of those on the Schedule C, and then everything else is just going to be considered an other expense, and you give the name and then the amount on this section of the Schedule C. So don't lose sleep over trying to come up with the perfect name for your chart of accounts. Just be consistent and make sure it makes sense for your business. Okay, now recording transactions. So when it comes to bookkeeping, I always tell people bookkeeping is a three-step process. You've got to record transactions, reconcile accounts, and generate financial statements. Now, that's what I'm about to talk about right now. Recording transactions, I already said, that's the same thing as categorizing transactions. This is what bookkeepers do. This is your bread and butter. This is what you're going to be spending the majority of your time doing. And now all of this largely depends on what software you're using. Basically, nobody does bookkeeping by pen and paper anymore. Maybe you're using Microsoft Excel, but all of my teachings are based on QuickBooks Online. If you're using that software, there's a bank feed where you can connect your checking account and your credit card directly to the software. This makes recording transactions so easy because the bank feed is going to automatically pull in the bank details of your transaction. So 90% of the work is already done. You have the date, you have the bank detail, and you have the amount. All you have to do is tell the software who did you pay and what did you buy, what is the category. So this makes recording transactions super easy and significantly more accurate. It's impossible to make a mistake with the amount or the date because it's pulled in directly from your bank. So recording transactions, you can do things manually with journal entries like the debits and credits I just talked about. And you're going to have to do journal entries if it's a non-cash transaction. So for example, if you acquired a truck by taking out a loan, you will have to do a journal entry to record that transaction because there was no actual cash. So if you just acquired a truck and took out a $50,000 loan, you would need to do a journal entry to record that transaction. That would be a debit to the asset, the truck, and then a credit to the truck loan. You can also manually record expenses and invoices if you're using QuickBooks Online. If you go to the plus new button in the top left-hand corner, you can manually record all of your transactions. However, you don't need to do that as long as you set up your bank feed to your bookkeeping software. And then finally, if you're a bookkeeper, if you're a business owner, and if you have questions, you've got to ask questions. Figure out the answer. Don't guess. Don't make stuff up. Don't skip stuff. If you're a bookkeeper, you got to ask the business owner, hey, how do I categorize this transaction? Who did you pay? What did you buy? I need some more information. Can you send me the bill of sale? Can you send me the loan origination document? Can you send me a picture of the check? I need more information. If you're a bookkeeper, this is so important. You've got to get the right answer. If you're a business owner, ask your accountant or ask your bookkeeper, how do I categorize this transaction? I don't want to make a mistake. Do you have any recommendations? What chart of accounts should I use? Okay, we're almost done here. Now let's talk about reconciling your accounts. So in QuickBooks, everything is a mirror image of your actual bank accounts or your actual credit card accounts. So you need to get the bank statements from your checking account so that you can reconcile your accounts in QuickBooks. Reconciling is simply making sure that everything is accurate. And the way that we do that, you can actually reconcile directly in your QuickBooks software. There's a button that you can push and it literally reconciles for you. And you want to make sure you do this in QuickBooks. This is not just you printing out a bank statement and this is not just a paper exercise. This is actually something you do inside of the QuickBooks software. It's so important. This is the most important step in bookkeeping because you are ensuring that your books are 100% accurate. You're making sure that everything is an exact match, and you do that by looking at the ending balance on your bank statement. So real quick, in your QuickBooks account, look at your check register, look at your checking account under your chart of accounts. Look at the ending balance as of March 31st, 2023. Now look at your March bank statement. Those balances should match perfectly. So if you have $10,000 in your bank account as of March 31st, according to your bank statement, you should also have $10,000 in your QuickBooks account underneath your checking account in the chart of accounts. It should also say $10,000. However, unless you have outstanding checks, this is the only time that your QuickBooks balance should be different than your bank balance because you might have recorded checks. So let's say you paid the general contractor, John Smith, you wrote him a check on March 31st for $1,000. You would record that in your QuickBooks, but it hasn't technically cleared your bank account yet because John Smith got that check on April 1st and he deposited it into his bank account on April 2nd. So it's going to clear your bank on April 2nd, but it's going to be recorded in your software on March 31st. So everything should be an exact match, penny for penny, whenever you reconcile, except for outstanding checks. And you get all the information you need from your bank statement. Super important. Okay, this is the last slide, financial statement. So like I said, bookkeeping is a 3-step process. Categorize transactions, reconcile your accounts, generate your financial statements. These two are the most popular financial statements. Profit and loss, balance sheet. I already talked about this in the beginning of the video. Profit and loss has your revenue and your expenses. This is what everybody cares about. This tells you how much money did I make, how much money did I spend, what's my net income left over. You should be sending this to your business owner clients every single month. If you're a business owner, you got to be looking at this every single month. This profit and loss is not just for taxes. This is for you to analyze the success and failures of your business so that you can make informed decisions. Your balance sheet has all of your assets and your liabilities and your equity. This is where you're going to see your loans, your accounts payable, accounts receivable, your checking account, your credit cards, your equity, your owner's pay, your owner's investment. Super important that you're looking at your balance sheet, especially if you have a lot of assets and liabilities. General ledger. This is only for your bookkeeper and your accountant, but the general ledger is a list of every transaction that you've ever recorded in your bookkeeping software. This is super important when it comes time for taxes and when it comes time to doing some research and trying to identify specific transactions. Don't be surprised if your accountant asks you for your general ledger at the end of the year. Finally, last thing I'm going to talk about, this is not necessarily a financial statement, it's more of a report, but your AP aging and your AR aging are so super important, especially if you're using QuickBooks to record and track your bills and your invoices. You need to be looking at your accounts payable to see, do I have any outstanding bills? And you need to be looking at your accounts receivable aging report so that you can see, do I have any outstanding invoices? Who do I owe money to? Who owes money to me? I hope this was helpful. I know debits and credits got a little crazy, but hopefully this teaches you a little bit about the fundamentals of accounting and the basics of bookkeeping.